Imagine a world where, your ability to buy groceries hinges on if some billionaire decides to buy another yacht. Sounds pretty crazy, right? Maybe not as far-fetched as you might think. Make sure you like and subscribe because today we're going deep on this, on how the U.S. economy has become surprisingly reliant on the spending habits of the ultra-wealthy. We unpack what's known as a rentier economy, where wealth comes from owning things, not making them. And we'll look at what that means for the rest of us. You might be surprised to learn that the wealthy of 10% of Americans are responsible for almost half of all consumer spending. It's a huge jump from just 3 decades ago. What's driving this trend? Well, it all comes down to income from assets. Things like stocks and real estate, giving the ultra-rich the power to splurge on luxury goods and services. Think about this. The top 10% of earners, those bringing in $250,000 or more a year, they've increased their share of total U.S. spending by about 14 percentage points over the last 30 years. That's a pretty significant shift in who's driving the economy. And their spending power is only amplified by gains in the stock market and real estate. So what happens when those markets take a hit? Well, this growing reliance on the spending of the wealthy is a classic sign of a rentier economy. It's a system where profits are generated primarily through owning assets rather than producing goods or services. It's about wealth through ownership, not through hard work or innovation. And this shift hasn't happened overnight. Decades of policies favoring the wealthy, including tax cuts and deregulation of the financial industry, it accelerated this trend. We've seen years of tax breaks for the rich, coupled with access to cheap money. And this has fueled a widening gap between the haves and the have-nots. In the aftermath of the 2008 financial crisis, for example, low interest rates allowed the wealthy to invest heavily. They watched their returns skyrocket, while many Americans struggled to get back on their feet. And meanwhile, many people across the country found themselves burdened with over $1 trillion in consumer debt. And as interest rates started to climb, guess who benefited? The wealthy, of course, who saw even higher returns on their investments. Like a rigged game, doesn't it? Cheap money allowed the ultra-rich to scoop up assets at bargain prices, and rising rates padded their portfolios even further. It's a system where the wealthy win, whether the markets go up or down. This brings us to the heart of the problem. Decades of deindustrialization, the rise of financialization, and the lasting legacy of Reaganomics. With its focus on deregulation and tax cuts for the rich, these have all steered the U.S. towards this rentier economy. We've moved away from an economy that values making things, one that prioritizes owning and exploiting assets. The more passively wealth accumulates, the more complex the financial systems behind it become. And for those in the top 10% whose fortunes are tied to a constantly growing stock market and grocery market, it's like winning a golden ticket. But for everyone else, it's a loaded gun, and it's pointed directly at their livelihoods. Think about it. If our entire economy relies on the rich spending their gains however they earn them, everyone else is at their mercy. It creates a system built on a fragile foundation. If they suddenly decide to stop spending, the whole system could just collapse. The rest of us are left holding the bag, hoping that one day some of that wealth will trickle down. This dependence on the spending habits of the ultra-wealthy has created a precarious situation, and beyond the widening wealth gap, it carries serious risks for the entire economy. A stock market dip or a decline in home values could shake the confidence of the top 10%, leading them to cut back on their spending. And that could have a ripple effect throughout the entire economy. Even a slight dip in consumer confidence among the wealthiest Americans could send shockwaves through the markets. Remember, the stock market isn't a direct reflection of the real economy. Wall Street isn't Main Street. That's why we can see record-breaking stock market performance while millions of Americans struggle to make ends meet. But that doesn't mean stock market fluctuations don't have real-world consequences. They shape expectations, influence behavior, and can trigger panic among investors. A sudden sell-off could lead to a broader economic contraction, and the fallout would hit everyday people the hardest. Because when an economy is designed to serve those at the top, those whose wealth is tied to asset growth, they can weather the storm. Everyone else, not so much. The threat of an economic crash is real, and some experts are sounding the alarm. With the nation's fortunes tied to the spending habits of tech giants and high rollers in the upper classes, any contraction in the stock market or pullback in spending by the asset-owning class could be devastating for the bottom 80%. During stable times, an unequal rentier economy is a ticking time bomb, but when we add factors like trade wars and tariffs into the mix, the situation becomes even more volatile. We'll dive into that in the next part of our deep dive. Now let's talk about trade wars. In an already precarious economic landscape, policies like tariffs can throw gasoline on the fire, right? Disrupt markets, drive up prices, and potentially lead to job losses, placing a heavier burden on the bottom, 80 to 90% of Americans. These are the folks already grappling with rising costs and stagnant wages, while the wealthy are often better equipped to ride out the storm. Is a bit ironic, isn't it? The very policies that are intended to boost domestic industries and protect American jobs, it can end up hurting the people that's supposed to help prices go up, jobs disappear. And the top earners, feeling the pinch, might start, tightening their belts. And this reduction in spending from the wealthy, that further exacerbates the crisis for everyone else. The idea behind these policies is often a call for a revival of American manufacturing, bringing back jobs in steel, automobiles, high-tech sectors. And while some investments in domestic manufacturing might materialize, the reality is that the burden of economic economic transition often falls disproportionately on the shoulders of those who can least afford it. Job losses, rising costs, a weakened safety net, these are the challenges faced by the majority, while the wealthy often find ways to profit from the turmoil. Reindustrialization, in theory sounds great, produce goods, secure supply chains, boost worker wages, and watch the economy thrive, right? But the reality is more complicated. Decades of decline in manufacturing capacity, coupled with weak labor protections, this can make this transition a bumpy road. And when you factor in the potential for wage suppression and the erosion of workers' rights, the picture becomes even bleaker for the average American worker. It's a system where the wealthy might have to forego a few luxury purchases during an economic downturn, but they're likely to recover and come out on top. Meanwhile, workers are left struggling, making incremental gains only to see them wiped out during the next economic shock. The cycle repeats, with the wealthy insulated for the worst of the fallout, while everyone else bears the brunt of the instability. The stark reality is that millions of Americans are grappling with a growing consumer debt crisis, living paycheck to paycheck, while the wealthy continue to thrive. This economic divide isn't some accident. It's a product of a system that has tilted the scales in favor of those who own assets. The system built on the shaky foundation of asset inflation and trickle-down economics that haven't delivered on their promises. It's house of cards, really. And while the wealthy may be enjoying a view from the top, for now, the question remains, how long could this imbalance last before the whole structure comes tumbling down? Let's delve deeper into the potential consequences of this economic model in the final part of our deep dive. So where does all this leave us? We've seen how the U.S. economy has become increasingly reliant on the spending of the ultra-wealthy, a hallmark of what we've been calling a rentier economy, right? And we've explored how this system, fueled by decades of policy choices, it's created a widening gap between haves and have-nots, leaving many Americans vulnerable to economic shocks. But maybe the most crucial question is this: can an economy built on the backs of a small percentage of ultra-wealthy individuals truly be sustainable in the long run? I mean, the current system, with its dependence on a perpetually booming stock market and ever-increasing asset values, it seems more precariously balanced. Any disruption to this delicate equilibrium, like a stock market correction or a decline in real estate prices, or even just a loss of confidence among its hot burners, it could send ripples throughout the entire economy. And while those at the top might be able to weather the storm thanks to their accumulated wealth and diversified investments, the majority of Americans would likely face the brunt of the fallout. And this raises some fundamental questions about economic fairness and long-term stability. Is it right for the prosperity of an entire nation to hinge on the whims of the select few? Can we continue down a path where the majority of citizens are essentially one market downturn away from financial hardship? These are questions we all need to grapple with. The answers are complex and there are no easy solutions. But one thing is clear: ignoring the growing imbalance in our economic system is a recipe for disaster. It's time to rethink the structures that perpetuate this inequality, to explore policies that promote shared prosperity, and to create an economy that works for everyone, not just those at the very top. The choices we make today will determine the kind of economy we leave for future generations. It's time to choose wisely. Don't forget to like and subscribe for more deep dives that explore the forces shaping our world. Thanks for listening.